right? But everything that we are talking about here on Forex actually applies to other markets. But we're using Forex as our main course of education for now. So the Forex market alone has over $7 trillion traded every single day. So every single day there is a volume of $7 trillion that is traded, both buying and selling, people buying and selling, buying and selling, buying and selling from across the whole world. $7 trillion every single day. That's the liquidity that comes into the forex market. That's why the forex market is one of the most liquid markets. Okay. So in forex, you trade currency pairs. What we trade is currency pairs. So we buy one currency while simultaneously selling the other. So if you are buying one currency, you are actually selling the other when it comes to forex. Why? Because these currencies are paired together. Okay. So even outside of forex, so let's say for example, you have a dollar, you got dollar from anywhere, someone sent you dollars, you have dollar, right, in your bank account, and you want to convert your dollar to naira, right, or you want to convert your dollar to any other currency. You cannot convert a certain currency if you don't have another currency you want to swap it with. It has to you have to go in tandem, like one goes the other way and the other goes the other way, right? You have to swap your dollar for another currency, or you have to swap your other currency with dollar, right? So when you go to your exchange office where you exchange your dollar, and you tell them you want to sell dollar to naira, and the value of selling dollar to naira is, let's say, 1,400 naira, and look for Nigerian naira to $1, right? So that's NGN, right? USD, right? So what you can see here is NGN, which is Nigerian naira versus or over US dollar. That's Nigerian naira US dollar. So let's open this up and see what is actually the current price that the Central Bank of Nigeria is selling the naira to big businesses, because all these black markets, they are not the ones that sell to huge companies, right? It's actually the central bank that does those deals, right? So what is the price of naira to $1 or dollar to one naira, right? So here now, what you can see is that we have 0.0007. Okay, you know what that means? I know you'll be surprised that why is it showing 0.0007 when we know how much we are paying for $1 in naira. So what this chart indicates, right? What this chart indicates is how much one naira cost. Sorry, how much $1 costs to purchase one naira, right? So this is what our naira cost in like the exchange market. This is what our naira is costing. Like if someone in the US wants to buy naira, how much are they going to pay to buy naira? They're going to pay $0.0007. That's about, I don't even know what that is, right? They're going to pay $0.0007 to buy one naira. So that means $1 could buy a lot of naira, right? $1 could buy a lot of one naira, right? So what this means is that this is what they are going to pay to buy one naira. Okay, so that's why this is first. This NGN, that's the first one, which is the base currency. That's the currency we are looking at each chart right now. Is the base one, and this is the quote. How much is it going to cost us in this currency, right? In this quote to buy the base currency. That's what you are seeing here. So it's going to cost 0.0007 of dollar to buy one naira. Then if I can switch this around and switch it to USD NGN instead of NGN USD, right? So USD NGN is now going to tell us the US dollar is going to be the base currency, USD NGN, right? So now we have USD and GN. The USD is now going to be the base currency and the Naira is going to be the quote. So we now open it up and here you can see it. The current price of Naira to USD is what? 1,343 Naira, 0.8971. That is the current price that the central bank is selling $1, right? It's selling $1 in Naira to all the businesses that are trying not moving, right? But the C is moving. Why? Because this numbers here on the C is indicating the current market price on this candle now. This candle that is open now. This moving sorry, if I move my crosshair, this thing that is moving around is my crosshair, right? So if I move it to any candle, the numbers are going to change for the OHLUC on top here, right? But if I'm not hovering on any candle, the numbers that you are seeing moving up and down on the C, which is the close, is the current price of this candle now that is not closed. This candle has about 7 days to close, right? So the current price is what the C is reading. So when this candle closes and another one opens, the C of this particular candle now becomes where this candle closed. Okay. So now to explain the OHLUC in detail, right? So let's go back to this. So you can see the open for bullish candles. Bullish candles are meant to go up, right? Increasing candles are meant to go up. So if something is meant to go up, the opening of that candle that went up has to be from the low, right? So it should open low and close high. That's what makes it bullish. A bullish candle opens low and closes high, while a bearish candle opens high and closes low. So the opening price for the bullish candle is higher than the closing price, and the opening price of a bearish candle is sorry. So what I intend to say is the closing price of a bullish candle is always higher than the opening price. It must be higher than the opening price for it to be called a bullish candle. And then the closing price of a bearish candle must be lower than the opening price. Okay. So I believe this, what I just said, that is very, very understood. It is easily understood. So if it opens at 15 and closes at 20, that's a bullish candle. But if it opens as 15 and closes at 10, it's a bearish, it will turn to a bearish candle, right? And then we have other things called the high and the low, right? So what we are looking at is the opening, high, low, and close, right? Remember from the initial statement I made, we look at open, high, low, and close. So if a candle opens, it's will likely, like most likely 100% or even 99% of the time, it will open, it will make a low, it will go back to that open, and then it will make a high. It might make a high up to a particular point and then come down and close, right? So if a candle opens, this becomes the open price, and that is this all of a sudden takes us a solid higher low. What you can see is that either price just go parabolic. I don't know, is it parabolic or what? It just dives, or price breaks that low and then start making what? The inverse of higher low and higher highs. It start making lower high, right? So this is a high, and this is a high that is lower than this, right? And then this is a low. So price makes a lower high and then a lower low, lower high, lower low on a bearish trend. So I'll just indicate this for you to understand. So what this is a lower high. So instead of LH, it turns to, instead of HL, it turns to LH. So you're now doing you're now flipping the switch, right? Going from this to that. So it's now lower high. And if price makes a lower high, it should make a what? A lower low. And there are people who trade the markets, and the only thing they are looking for is lower highs and lower lows. There is this certain guy who actually is quite popular. His name is Sai, right? He trades like each trade from him is like it's like millions in dollars. And the only thing he does is trading higher lows and higher highs, and lower lows and lower highs. He's not looking at any difficult stuff, right? He's just doing lower highs and lower lows, and he mastered how to trade lower highs and lower lows. Okay, and he's making money just by trading lower highs and lower lows. So this sorry, this should be a low. Let me delete that. This should be a low, and this is the high. So he made a high, and then it made a low below the structural low. So we call this structural low. This market structure. What is the structure? The structure is making higher highs and higher lows, higher highs and higher lows. And when the structure shifts from making higher highs and higher lows to making a new low, like a low past the structural higher low, that means the trend have changed. And now we are expecting price to do what? To make lower highs, lower low, lower highs, lower low. That means now we are trending down. So now applying this on the chart, I believe that we have gotten this information. Applying this on the chart, where can we see it? So on the chart, it's not going to look as clean as what I just drew there, right? That's why you need to understand the chart. It's not going to look as clean as that. So at this point, from this point on, price started doing what? Trending up. Okay. So you can see price made a low, the support. But then when price started moving down, it didn't respect this level. It just broke back below it. So that's why I said a level of support or a level of resistance, it is not guaranteed to hold, but it holds a lot of times, right? It holds a lot of time, more times than not, it holds, but it is not guaranteed. So there has to be other factors that comes into play before a support and resistance holds very well. So keep that in mind. And now you can see price comes back down to this support and then holds this support, goes up, holds this resistance, goes down, holds this support, and then this resistance gets broken. And immediately this resistance gets broken, it turns what? It becomes support. And price holds this support, goes up to this resistance, hold the resistance, goes down, holds the support, and then boom, it breaks out of that resistance. And now it might take it as support or it might roll back down. And then remember what we explained um in the last level where we talked about higher lows and higher highs, higher lows and higher highs. You can see that this thing now, what's going on here is that price is trending. This is an uptrend, right? This is an uptrend, but within these uptrends, we are seeing where support and resistance are playing a part in this uptrend, right? So price, we know that price is going up. So let's say we all know that price is going up and price is in an uptrend. We do not intend to start selling resistance. Why? Because generally price is doing what's going up. So if price is going up, we expect to only do what? Buy. So you remember something about Fibonacci and say, okay, if price is trending down, we do expect price to retrace. And if you use Fibonacci to measure retracement, mostly price tends to do what? Retrace anywhere within 50% and 62% of the Fibonacci. So now we use the Fibonacci just to ensure that this area of resistance that we are trying to sell, because there are also other resistance. So we want to ensure that this area of resistance we are trying to sell is strong enough, right? Because if you have an area of resistance and then you couple that with Fibonacci, so you have a Fibonacci telling you that, okay, this is a possible area of retracement. And then we also have a resistance that have been broken, telling you this is also a possible level of retracement. Then it's stronger because you have two confluences. Confluences mean you have two things that tells you this can work. So you place your Fibonacci from high to low. So for me, you can see my Fibonacci, I'm using only 79 and 62%. 62% and 79 is almost the same thing as saying 78.6. Okay, 78.6 rounded up is 79 and 61.8 rounded up is 62. So it's still the same thing. So now if you draw your fib from high to low, you find out that we have resistance, we have fib. So anything beyond 62%, we are looking to sell. So now we have seen we have 62%, we have resistance here. So if at this point price is new, at this point price is here, what we are now looking to do, because we have other informations, we have trend, lower highs and lower lows, we have fib, and then we have support broken that should turn resistance. Then what we can do is, since price can move into this fib, then we can say if price moves into this area, I want to sell here, and I know that price is trending down, and if price is trending down, it should not go past the previous what the previous high it made. It should make a new what lower high. So we are looking to sell at a potential level that we think price is going to make a lower high, and we expect it to do what, make a lower low. So a lower low is going to be below the low is made. And also remember what I said, if we are selling, so remember what we said about liquidity. So if you're looking to sell, price, since price reverse from here, that means there is liquidity here. That means a lot of people bought here, and if price wants to go back up, it needs to what, take out liquidity before it reverse. So we can say, okay, here, this is where I'm looking to target. Immediately price takes out that liquidity. That's what I'm looking to target. And then what happens? Now you have with the things that I've explained, the things that I've taught, you have now framed a potential trade. Now this is no longer gambling. You have an idea, you have a plan. I don't need to do that calculation. So what I'm going to do is I'm going to move this to, let's just do it at 2. Right? So it's at 2 now. That means if you are risking $100 and this trade goes in your favor and you win this trade, you're going to make what? 200. So if you enter here and price starts to, move up here, you're going to be seeing red on your NT5. Okay, and immediately it hits here, it's going to close out your trade at loss. But if it starts to go down, you're going to be in profit, and if it hits this level, you're going to what, make $200. So this is your risk reward, and this is a positive risk reward, which is 1 to 2. You are risking less to make more, right? So you are making more than you lose. So some people, their risk reward is going to be something like this. So most times you see traders online, they open a trade and then they give it enough room for stop loss, and then the trade moves in profit and they say close, close. That's how a lot of signals work these days. So they say close and you are closing and thinking you're making profit. The day you lose, you find out that you're losing more than you are making. Okay, because the risk reward is not profitable. So for somebody to be able to trade this type of risk reward, their win rate has to be very high. At least a 70% win rate if you are trading like this. Like if you are taking profit that is less than what you're risking, you have to have at least a 70% win rate, where you know that if you take 10 trades, you are going to do what? Win at least 7. So with that, it's going to put you about, for example, if you take 10 trades for and you're risking $100 in each of those trades, if you lose 10, you're going to lose 1,000. Okay, you're going to lose $1,000. But then if you win all of your trades when you're taking a 1 to 2 hour and you're risking $100, if you win all of them, you're going to make what? $200. Sorry, you're going to make $2,000 because you're making 200 for every single win. So let's now say you take 10 trades, right? So you take 10 trade. Let me increase this. You take 10 trades and you win what? You win four. Sorry, win four. And then you lose, that should be six. That makes it 10. Okay, you win four and lose six. So out of every four you win, you make $200. So two times four is what? Eight. I agree, does it? Right? Two times four is eight. So you make 800 for all your wins, for total wins after 10 trades. So W equals what? 800. And then for the losses you took six losses. And the losses equals what? $600. So what you do now is 800 minus 600. If you minus 600 from 800, that puts you at a net profit of what? $200. Okay, so after 10 trade, you are making what? $200 just by what? Winning only four and losing what? Six. So you can see, even though you are losing more, you are still profitable overall. So let's say this your risk reward per trade is one to what? One to three. Okay, if it's one to three, that means out of booted. Also, sometimes you might still go on winning streaks when you make like five, six, seven, 8 wins in a row. So you can actually tell, as long as you are following your processes, as long as you are following your system. That's what actually matters. Then focus on building a solid trading system, managing risk effectively, and maintaining the right mindset. Avoid comparing your journey to what you see on social media. Real trading success is built through experience and consistency over time. So if you keep doing the same thing over and over again, it just becomes muscle memory. Stop comparing yourself. Try to build your own solid trading system. Never place too much focus on the outcome of the next trade. Instead, think in probability. When you understand trading is a game of probability, fear of losing reduces and you can make decision clearly. So don't think that the next one is going to be a win. The next trade is going to be a loss. You don't know. As long as you're following your system, unless you do something otherwise, you don't know what's going to happen in the next trade. Then find satisfaction in the process, not the results. Happiness is in the doing and not in the results. If you are not happy following the process, then the results are never going to come. Right? The good times are never going to come if you're not happy following the system. Avoid jumping from one strategy to another in search of the holy grail. This was where I made the highest mistake ever, because I didn't learn trading from anyone. I was just learning from YouTube here and there. I never paid for courses. So this was what really took me a lot of time to become profitable. I was going from this to this, from this to this. This new strategy comes out. A mentor that is just trying to sell, right, comes out telling us that no strategy works better than his. We jump from this to that, right, doing a lot of things and wasting time. There was I was not focused on one single strategy and work to get better at it. I was just going from one place to another.